Question 1. In a consortium blockchain used by 5 banks to validate interbank transactions, which consensus mechanism best balances fault tolerance, performance, and energy efficiency? Evaluate the following options considering the trade-offs in permission settings. A. Proof of work POW. B. Practical Byzantine fault tolerance PBFT. C. Delegated proof of stake DPoS. D. Proof of stake PoS. Correct answer: B. Practical Byzantine fault tolerance PBFT. Explanation: PBFT suits permission networks with known nodes like banks by providing deterministic consensus with high throughput and low latency, tolerating up to 1/3 malicious actors. POW is energy intensive and slow. PoS still needs staking incentives and isn't optimized for small consortiums. DPoS introduces centralization and potential collusion. PBFT is widely used in enterprise blockchains for these reasons. Question 2. Which principle under the FATF travel rule primarily aims to prevent money laundering in crypto transfers? And what practical requirement does it impose on VASPs? A. Transparency. VASPs must publicly publish their transaction ledger. B. Beneficial ownership. VASPs must collect end-user identity data for transactions over a threshold. C. Decentralization. VASPs must remain distributed to avoid systemic risk. D. Anonymity protection. VASPs must obscure sender-receiver IDs. Correct answer: B. Beneficial ownership. VASPs must collect end-user identity data for transactions over a threshold. Explanation: the FATF travel rule requires virtual asset service providers, VASPs, to collect and share originator and beneficiary info for crypto transfers above a threshold, e.g. USD 1,000, to trace beneficial ownership and prevent illicit finance. This aligns with KYC AML frameworks. Options A, C, and D misinterpret core FATF aims. Question 3. Consider a country that introduces a retail CBDC to enhance financial inclusion. Which policy challenge is most likely to arise, requiring central bank intervention? A. CBDC use is limited because it can't support offline payments. B. Oversubscription of CBDC leads to disintermediation of commercial banks. C. CBDC cannot be integrated with existing payment rails. D. CBDC inherently increases inflation by expanding money supply. Correct answer: B. Oversubscription of CBDC leads to disintermediation of commercial banks. Explanation: when citizens shift large deposits to risk-free CBDCs, banks lose funding for lending, pressuring interest rates and credit provision. The central bank must manage tiered remuneration, caps, or incentives to stabilize monetary transmission. Options A and C are technical design questions. D is simplistic, assuming CBDC automatically increases supply. It's neutral if replacing cash. Question 4. Public blockchains are praised for decentralization and transparency. However, which core property is fundamentally incompatible with full anonymity and why? A. Immutability. B. Decentralization. C. Transparency. D. Fungibility. Correct answer: C. Transparency. Explanation: public blockchains record all transactions on a visible ledger. Transparency ensures auditability, but it conflicts with anonymity since addresses and flows are traceable, linking identities through on-chain analysis. Immutability supports audit trails, fungibility is about interchangeability, and decentralization concerns node architecture, not anonymity. Question 5. A digital asset qualifies as a security in the U.S. if it meets the Howey test. Which scenario reflects a violation due to this classification? A. A decentralized token used solely for network fees. B. A stablecoin pegged to USD, but with transparent reserve audits. C. A token sold with promises of profits based on managerial efforts. D. A privacy coin with no profit-sharing scheme. Correct answer. C. A token sold with promises of profits based on managerial efforts. Explanation. The Howey test identifies an investment contract if there's investment of money in a common enterprise with expectation of profits, primarily from managerial efforts. So, tokens sold with profit claims are securities under SEC. Utility tokens, stable coins with reserves, and coins without profit motives typically fall outside Howey. Question 6. Scenario. Ms. Rivera, a central bank policymaker, is tasked with deploying an algorithmic stablecoin pegged to her country's fiat currency to facilitate cross-border remittances. However, the smart contracts use seigniorage-style expansion contraction, with collateral partly in volatile crypto. What key economic risk must Ms. Rivera mitigate before launching, and what monetary mechanism could address it? A. Regulatory risk. Register as a security under SEC rules. B. Liquidity risk. Establish a standing repo facility for collateral floats. C. Exchange rate risk, pegged to multiple fiat currencies. D. Deflationary spiral. Impose negative interest on holdings. Correct answer. B. Liquidity risk. Establish a standing repo facility for collateral floats. Explanation. Algorithmic stablecoins using volatile collateral can face liquidity shortages during stress, affecting peg stability. A policy repo facility allows the central bank to lend liquidity against fluctuating collateral to stabilize it. Regulatory or deflationary tools are less targeted. Pegging to multiple currencies tackles exchange rate but not liquidity. Question 7. In a PoS public blockchain that uses slashing, which attacker behavior does slashing primarily deter, and how? A. Double spending by malicious forks, by permanently punishing misbehaving validators. B. DDoS attacks on nodes, by reducing stake to offline actors. C. Privacy breaches, by encrypting stake data. D. Smart contract bugs, by halting execution on failures. Correct answer. A. Double spending by malicious forks, by permanently punishing misbehaving validators. Explanation. Slashing penalizes validators who sign conflicting blocks, reducing their stake to disincentivize double signing or equivocation. It doesn't address DDoS, privacy, or smart contract bugs directly. Question 8. An exchange operates across both MAS, Singapore, and FCA, UK jurisdictions. For AML compliance under both agencies, which action is required? A. Only collect U.S. user KYC per FinCEN. B. Share transaction data directly on-chain. C. Implement risk-based customer due diligence, meets both local standards. D. Exempt privacy coins entirely. Correct answer. C. Implement risk-based customer due diligence meets both local standards. Explanation. Both MAS and FCA require risk-based CDD, including KYC, enhanced due diligence for high-risk clients, and ongoing monitoring. They don't require U.S. standards or blockchain disclosure. Privacy coin treatment depends on risk, not blanket prohibition. Question 9. What is the primary mechanism through which a retail CBDC can enhance the effectiveness of negative interest rates? A. Encouraging users to hold cash outside the banking system. B. Enabling direct application of negative rates to retail accounts. C. Outsourcing monetary policy implementation to fintech apps. D. Preventing government surveillance of spending. Correct answer. B. Enabling direct application of negative rates to retail accounts. Explanation. With CBDC deposits at the central bank, negative interest rates can be applied directly to holdings, encouraging spending. cash hoarding becomes less attractive or is discouraged via design, e.g., demurrage. The other options don't directly strengthen negative rate transmission. Question 10. Layer 2 rollups, e.g., Optimistic or ZK, seek to scale public blockchains. What key trust POP guarantee differentiates ZK rollups from optimistic rollups? A. ZK rollups require user fraud proof submission only. B. Optimistic rollups generate cryptographic proofs for off-chain TX batches. C. ZK rollups provide validity proofs before state updates, removing challenge periods. D. Optimistic rollups encrypt all transactions. Correct answer. C. ZK rollups provide validity proofs before state updates, removing challenge periods. Explanation. ZK rollups post cryptographic validity proofs ensuring correctness. No need for post-factum challenge. Optimistic rollups assume correctness and rely on fraud proofs during challenge windows, delaying finality. Question 11. Scenario. Mr. Anderson runs a DeFi protocol offering yield farming in the EU. A user's funds are lost due to an exploit in the smart contract. EU regulators consider applying MiCA rules retroactively. What compliance principle should Mr. Anderson have followed to reduce legal risk under MiCA? A. Register under GDPR for data privacy. B. Acquire an EMI license for e-money services. C. Maintain sufficient reserves and transparency via white paper disclosures. D. Implement anti-Sybil measures on validators. Correct answer. C. Maintain sufficient reserves and transparency via white paper disclosures. Explanation. MiCA requires stablecoin and token service providers to maintain transparency, hold reserves, and clearly disclose risks. While DGPR and EMI may apply, the key is reserve backing and disclosure, essential for legal compliance in the event of a financial loss. Question 12. Which feature of token-based CBDCs best supports offline payments while preserving anti-money laundering controls? A. Maintaining exact real-time balances. B. Utilizing cryptographic value tokens and threshold transfers. C. Issuing bearer instruments like paper money. D. Connecting directly with central credit bureaus. Correct answer. B. Utilizing cryptographic value tokens and threshold transfers. Explanation. Token-based CBDCs can be designed for offline transactions using cryptographic tokens with limits, thresholds, to balance usability and AML control. Real-time balance maintenance is impossible offline. Bearer instruments replicate cash. Credit bureau linkage isn't relevant. Question 13. In designing a blockchain solution for asset tokenization, what is the key reason why developers must choose between public and private blockchain architectures? A. Public chains offer better scalability for tokenized real estate projects. B. Private chains allow unregulated token trading across jurisdictions. C. Private chains support confidentiality, critical for regulated asset data. D. Public chains enable full GDPR compliance due to immutability. Correct answer. C. Private chains support confidentiality, critical for regulated asset data. Explanation. Tokenized real-world assets often carry sensitive financial and ownership data. Public chains, while decentralized and transparent, expose transaction data to all. Private or consortium chains can restrict visibility, ensuring compliance with data protection laws, e.g., GDPR. Public chains' immutability conflicts with data erasure requirements, a challenge in the EU legal framework. Question 14. Which compliance challenge is most likely when a stablecoin issuer claims fiat backing, but holds reserves in short-term commercial paper without user visibility? A. They fail to meet staking mechanism rules. B. They breach KYC onboarding obligations. C. They may mislead investors under securities and consumer protection laws. D. They violate smart contract transparency rules. Correct answer. C. They may mislead investors under securities and consumer protection laws. Explanation: when fiat-backed stablecoins are opaque about reserves or hold risky instruments, e.g., Evergrande CP, they may violate consumer protection laws and face scrutiny from SEC, FCA, or MAS, depending on user jurisdiction. Misrepresentation of backing equals potential fraud and unregistered securities offerings. Question 15. Scenario: Dr. Wang, a central banker in a developing country, proposes issuing a CBDC to reduce cash printing costs and increase tax compliance. However, cash use is deeply entrenched, especially in informal sectors with little digital access. What strategy should Dr. Wang implement to maximize CBDC adoption while preserving economic stability? A. Mandate CBDC-only payments for all government services. B. Incentivize CBDC use via targeted subsidies and offline wallets. C. Replace all physical cash within 6 months. D. Use programmable expiration to force immediate use of CBDC. Correct answer: B. Incentivize CBDC use via targeted subsidies and offline wallets. Explanation: BIS and IMF recommend gradual CBDC rollouts that target adoption via incentives, such as G2P transfers and offline capabilities to include remote populations. Forcing full transition risks economic exclusion and informal sector shrinkage. Question 16. Which of the following is a key limitation of current smart contracts on Ethereum that affects legal enforceability in financial services? A. Lack of support for token creation. B. Limited decentralization of miners. C. Smart contracts lack human-readable legal logic. D. Requirement to hold ETH to read contracts. Correct answer: C. Smart contracts lack human-readable legal logic. Explanation: smart contracts are machine-executable code, not human-readable contracts. Legal enforceability, per ISDA, EU FinReg requires clarity on terms, jurisdiction, and dispute resolution. While legal code convergence is evolving, e.g., Accord Project, contracts today still require off-chain legal interpretation. Question 17. Which taxation risk arises when a DAO pays contributors using governance tokens that rapidly appreciate and are tradable? A. The tokens are not taxable because they're utility-based. B. Contributors must file capital gains only when selling tokens. C. Receipt may trigger income tax based on fair market value. D. Only the DAO treasury is liable for tax, not the individuals. Correct answer: C. Receipt may trigger income tax based on fair market value. Explanation: most tax authorities, e.g., IRS, HMRC, treat token compensation as ordinary income upon receipt, valued at market rate. Later gains/losses affect capital gains. Misreporting or treating them as non-taxable airdrops creates liability. Question 18. What economic function does a wholesale CBDC serve better than a retail CBDC, particularly in the interbank clearing environment? A. Direct lending to consumers. B. Eliminating commercial banks from monetary policy. C. Real-time gross settlement between financial institutions. D. Offering programmable expiration to retail customers. Correct answer: C. Real-time gross settlement between financial institutions. Explanation: wholesale CBDCs are designed to replace or complement RTGS systems, enabling faster, programmable, and atomic settlement of large-value transactions. Retail CBDCs serve the public, but wholesale CBDCs address liquidity management and clearing efficiency at the institutional level. Question 19. Scenario: Ms. Kovacs is designing a blockchain-based land registry system for a consortium of African countries. One major requirement is the ability to revoke or update fraudulent entries, such as double registrations. Which blockchain design choice best supports this requirement without compromising too much on trust? A. Use a fully public, immutable Ethereum smart contract with no admin keys. B. Implement a permissioned ledger with controlled validator rights. C. Use IPFS for documents, but rely on notarized paper deeds. D. Embed time-lock smart contracts to auto-expire invalid records. Correct answer: B. Implement a permissioned ledger with controlled validator rights. Explanation: For government record systems, immutability must be balanced with administrative oversight to correct errors or fraud. A permissioned blockchain, e.g., Hyperledger, allows selected nodes, e.g., land offices, to govern updates with audit trails, satisfying legal accountability. Question 20. Which regulatory compliance framework obliges VASPs to transmit originator and beneficiary information for virtual asset transfers across borders? A. BIS Basel III. B. FATF Recommendation 16, Travel Rule. C. SEC Regulation D. D. GDPR Article 17. Correct answer: B. FATF Recommendation 16, Travel Rule. Explanation: The Travel Rule Rec. 16 by FATF mandates that VASPs collect and transmit identifying information for cross-border crypto transfers to combat AML-CFT risks. It mirrors SWIFT-like data requirements and is being implemented in the EU via MiCA, US, FinCEN, and APAC regions. Question 21. In the context of CBDC design, what is a major trade-off between a token-based model and an account-based model for financial inclusion? A. Token-based models cannot be interoperable with mobile money. B. Account-based models require full bank accounts and IDs, limiting access. C. Token models are incompatible with FATF AML rules. D. Account-based systems are banned by the BIS. Correct answer: B. Account-based models require full bank accounts and IDs, limiting access. Explanation: Account-based CBDCs require identity verification and onboarding, creating barriers in unbanked populations. Token-based models, e.g., ECNY Lite wallets, allow pseudonymous or tiered access, enhancing inclusion per BIS and IMF studies. Question 22. What key security risk arises if a smart contract lacks proper reentrancy protection, especially in DeFi platforms? A. It delays block finality. B. Attackers can repeatedly call a function before balances update. C. Only validators can exploit such bugs. D. It forces immediate settlement, increasing volatility. Correct answer: B. Attackers can repeatedly call a function before balances update. Explanation: Reentrancy attacks exploit functions, e.g., withdrawal, to recursively call themselves before internal state is updated, draining funds. This was the cause of the DAO hack in 2016. Best practice: use checks interactions pattern and mutexes. Question 23. Scenario: Mr. Delgado offers a decentralized lending app where users can deposit crypto to earn yield, and borrowers receive loans in stable coins. A regulator argues the app might be issuing unregistered securities. What is the most relevant legal test the regulator will apply in the U.S., and why might the app qualify? A. MiFID II. App is not located in Europe. B. Howey test. Platform offers expectation of profit from others' efforts. C. GDPR. Data use is improperly disclosed. D. Basel II. App lacks proper capital buffers. Correct answer. B. Howey test. Platform offers expectation of profit from others' efforts. Explanation. The Howey test checks for investment contracts. Investment of money in a common enterprise with expectation of profit primarily from efforts of others. Yield-bearing DeFi apps often meet these criteria, triggering SEC scrutiny. Question 24. Why is programmability a key feature in digital monetary instruments, and what risk does it introduce? A. Enables offline use, but increases memory usage. B. Allows conditional spending, but may lead to policy overreach. C. Prevents inflation by freezing prices. D. Improves network latency, but degrades transparency. Correct answer. B. Allows conditional spending but may lead to policy overreach. Explanation. Programmable CBDCs can be coded to expire, restrict use, e.g., subsidies only for food, or automate tax collection. However, this raises concerns of financial surveillance, policy creep, or limiting individual financial autonomy. Question 25. A Layer 1 blockchain network is experiencing significant congestion due to NFT minting and DeFi transactions. Which Layer 2 solution is most appropriate to alleviate this pressure without sacrificing the underlying security of the Layer 1 chain? A. Sidechains with separate consensus mechanisms. B. Sharding across the main Layer 1 protocol. C. Zero-knowledge rollups with cryptographic proofs. D. Fully off-chain transaction processing. Correct answer. C. Zero-knowledge rollups with cryptographic proofs. Explanation. ZK rollups compress many off-chain transactions into a single proof submitted to the Layer 1 blockchain, which verifies it cryptographically. This maintains Layer 1 security while increasing scalability. Sidechains use separate consensus and may compromise security. Sharding is Layer 1 scaling. Fully off-chain models, e.g. state channels, don't provide public auditability or shared security guarantees. Question 26. A centralized exchange lists a new digital token and markets it heavily, stating it will soon double in value. Under the U.S. securities law, what major regulatory risk is introduced by this behavior? A. Violation of tax evasion, reporting obligations. B. Improper implementation of cold wallet custody. C. Promotion of an unregistered security via public offering. D. Breach of consensus protocol disclosure. Correct answer. C. Promotion of an unregistered security via public offering. Explanation. Promoting a token with guaranteed profit language can meet the Howey test for securities, investment plus common enterprise plus profit expectation plus others' efforts. If the token is not registered with the SEC, the exchange could be liable for promoting and facilitating unregistered securities. This is a common legal action taken by U.S. regulators. Question 27. Scenario. Mr. Mbatha is a finance minister in a rapidly digitizing African economy. He wants to implement a CBDC to help formalize the informal sector and improve cross-border remittances. However, his team warns that foreign CBDCs could crowd out the local one due to network effects and currency substitution. What is the most appropriate monetary policy strategy to preserve sovereignty? A. Ban all foreign CBDCs outright. B. Offer higher interest rates on the local CBDC compared to bank deposits. C. Implement capital controls to throttle foreign digital currency flows. D. Promote interoperability standards while incentivizing local CBDC use. Correct answer. D. Promote interoperability standards while incentivizing local CBDC use. Explanation. The BIS and IMF warn against currency substitution, dollarization, from foreign CBDCs. Instead of banning them, best practices suggest interoperability frameworks, e.g., mBridge, and local incentives, e.g., tax rebates or faster settlement to keep the local CBDC attractive while still allowing cross-border functionality. Question 28. Which of the following statements best explains why practical Byzantine fault tolerance, PBFT, is favored in permissioned blockchains but not in large-scale public networks? A. PBFT has no finality, making it unsuitable for smart contracts. B. PBFT offers high throughput, but suffers from communication overhead in large networks. C. PBFT works only if tokens are staked across validators. D. PBFT cannot detect node failures or faulty inputs. Correct answer: B. PBFT offers high throughput but suffers from communication overhead in large networks. Explanation: PBFT achieves fast consensus and finality, but requires O(n)2 communication between all nodes. This is manageable in small, permissioned environments, like bank consortiums, but doesn't scale well in public chains with hundreds or thousands of nodes. That's why POW and POS are preferred in public blockchains. Question 29. Under the EU MiCA regulation, what obligation does an issuer of an asset reference token, e.g., stablecoin backed by multiple assets, have to legally operate in the European Union? A. They must only disclose smart contract source code. B. They must be licensed and maintain a white paper approved by national competent authorities. C. They only need to register with the ECB. D. They must burn 1% of tokens every quarter to ensure scarcity. Correct answer: B. They must be licensed and maintain a white paper approved by national competent authorities. Explanation: under MiCA markets in crypto-assets regulation, issuers of asset reference tokens ARTs must publish a detailed white paper, obtain a license, and ensure adequate reserve management and transparency. MiCA is the EU's comprehensive framework for regulating stablecoins and crypto assets starting in 2024-2025. Question 30. Which of the following best explains why programmable monetary policy via smart contracts could challenge central banks' conventional role? A. It automates payments in retail stores. B. It removes the need for legal tender laws. C. It enables monetary decisions to be embedded in decentralized protocols. D. It reduces volatility in equity markets. Correct answer: C. It enables monetary decisions to be embedded in decentralized protocols. Explanation: smart contracts allow developers to embed interest rate logic, inflation adjustments, or velocity controls into tokens, creating decentralized monetary systems that operate independently of central banks. This undermines centralized monetary control and creates shadow monetary policy, as highlighted in IMF and BIS reports on DeFi.